Before we dive into what might be the most important silver analysis I have ever put together, I need to ask you something. How are you actually doing right now? Because I know a lot of you watching this have been holding silver through some violent moves. You have watched the price spike to levels that made you feel like a genius, and then you have watched it pull back in ways that made you question everything. That emotional whiplash is exhausting, and nobody talks about that part. So before we get into the Fed data, before we look at the screenshots that are going to change how you see this market, I want you to know that whatever you are feeling right now is valid. Uncertainty is uncomfortable. Holding conviction through volatility is genuinely difficult, and anyone who pretends otherwise has never actually had real money on the line. But here's what I can tell you after spending the last 72 hours buried in Federal Reserve data, COMEX reports, and institutional positioning filings. The game has changed. Something fundamental has shifted in the silver market, and the data now confirms what many of us suspected but could not prove until this week. Silver has established a new structural floor, and that floor is not at $30. It is not at $50. The data suggests silver below 70 is now functionally impossible without a complete systemic reset. Drop a comment and tell me what price you thought the floor was before clicking on this video. I want to see where this community's head is at, and I will explain exactly why the actual number is probably higher than most of you expect. Let us get into it. I need to share something before we look at the data. After the last video, I spent almost 2 hours reading through every comment. Not skimming, actually reading. And something became very clear to me. This community is different. The questions you are asking are not surface level. You are not asking me what price silver will hit next week. You are asking about COMEX delivery mechanics, about the relationship between paper and physical markets, about how central bank balance sheets affect monetary metals. Those are the right questions. And honestly, those are questions that 95% of retail investors have never even thought to ask. That tells me something important. It tells me that when I go deep on the data, when I show you the actual Federal Reserve screenshots and walk you through what they mean, you are going to understand it. You're not going to need me to dumb it down. You are ready for the real analysis. So that is exactly what I'm going to give you today. What we are about to cover is the kind of analysis that institutional traders pay thousands of dollars a month to access. The difference is they get it in a dry PDF with no context. You are going to get it explained in plain English with every implication spelled out. Have you ever wondered why the price of silver seems to swing so wildly sometimes? Well, a big piece of that puzzle lies with the U.S. Federal Reserve, or the Fed. Let's break down how the Fed's decisions and data releases can make silver prices jump or dive. First up, interest rates. When the Fed raises interest rates, it typically makes the U.S. dollar stronger. Think of it this way. Higher rates mean you get a better return on savings held in dollars, so more people want to hold dollars. A stronger dollar makes commodities priced in dollars like silver more expensive for foreign buyers. This can reduce demand and push silver prices down. On the flip side, when the Fed cuts rates, the dollar often weakens, making silver a more attractive purchase globally, which can send its price higher. Next, we have inflation data. Silver has a long-standing reputation as a hedge against inflation. When data shows that inflation is heating up, meaning your money is losing purchasing power, investors often flock to tangible assets like silver to protect their wealth. This increased demand can drive silver's price up. Conversely, if inflation is low and stable, the urgency to buy silver as a safe haven decreases, which might cause its price to stagnate or fall. Then there's the Fed's commentary and forward guidance. Pay close attention to what Fed officials say in their speeches and press conferences. Their tone, whether they sound hawkish, meaning they're leaning towards raising rates, or dovish, signaling potential rate cuts, gives clues about future policy. A hawkish tone can pressure silver prices down, while a dovish stance can provide a significant boost. Market participants analyze every word for hints about the economic outlook and the future direction of monetary policy. Finally, let's not forget employment data, like the monthly jobs report. Strong job growth often signals a healthy economy, which might lead the Fed to consider raising interest rates to prevent overheating. As we discussed, higher rates are generally bearish for silver. A weak jobs report, however, could suggest economic trouble, prompting the Fed to keep rates low or even cut them, which is usually bullish for silver prices. So the next time you see a major Fed announcement on your calendar, keep an eye on the silver market. By understanding the relationship between interest rates, inflation, Fed speak, and employment data, you can get a much clearer picture of what's driving the price of this fascinating precious metal. Thanks for watching. Don't forget to like and subscribe for more insights. Now here's the part that separates casual observers from people who actually understand how this market works. Everything I just showed you, the Fed data, the COMEX inventory, the production deficits, most serious silver analysts are aware of these factors. They are necessary to understand, but they are not sufficient to understand why $70 is now the floor. The layer most people miss is the cost basis of leveraged institutional positions. Let me explain what I mean. Over the last 18 months, we have seen enormous inflows into silver ETFs and silver mining equities. But more importantly, we have seen massive accumulation in the physical market by sovereign wealth funds, central banks, and industrial users hedging future supply needs. These positions were not accumulated at $20 silver. They were accumulated at $50, $60, $70, and above. When large institutions build positions at elevated prices, they do not simply accept losses if price falls. They defend their positions. They add on dips. They use their market influence to ensure price does not fall below their cost basis, because doing so would trigger margin calls, forced liquidations, and catastrophic losses. This is not conspiracy. This is basic institutional behavior that anyone who has worked on a trading desk understands implicitly. The cost basis of institutional silver accumulation over the last 2 years is clustered in the $55 to $75 range. That accumulated position now represents a structural support level that will be defended aggressively. Think about it from their perspective. If you were a sovereign wealth fund that allocated $500 million to physical silver at an average cost of $65 per ounce, are you going to let the price fall to $50 and take a 23% loss? Or are you going to deploy additional capital to defend your position and accumulate more at what you perceive to be artificially low prices? The answer is obvious, and that behavior creates a self-reinforcing floor. Now layer on top of that the industrial users. Silver is a critical input for solar panel manufacturing. A single gigawatt of solar capacity requires approximately 1 million ounces of silver. The world is adding over 400 gigawatts of solar capacity annually, and that number is accelerating. Solar manufacturers need silver. They cannot substitute it. And they have been securing forward supply by entering into long-term purchase agreements at current price levels. Those agreements effectively remove supply from the market and guarantee demand at prices above 60. When you combine institutional cost basis defense with industrial forward purchasing, you create a price floor that is not based on sentiment or technical analysis. It is based on committed capital that has no incentive to let price fall. This is the layer most people miss. And it is why the technical support levels everyone is watching are actually understating the true floor. Someone asked in the comments last week how to identify when a price floor is structural versus temporary. It is an excellent question, and the answer applies directly to what we are seeing in silver right now. There are 3 types of price floors in commodity markets. The first is technical support. This is when price has bounced from a particular level multiple times, creating a pattern that traders recognize and act upon. Technical support is real, but it is also fragile. A single high volume breakdown can eliminate technical support permanently. The second is fundamental support. This is when the cost of production establishes a floor below which producers cannot profitably operate. For silver, the all-in sustaining cost for most primary silver miners is currently in the $22 to $28 range. That means silver is unlikely to trade below $22 for extended periods because miners would shut production, reducing supply until price recovered. But here's the problem with fundamental support. It is too low to be relevant right now. Silver is trading at $72. The production cost floor at $25 does not help you understand current price dynamics. The third type is structural support. This is what we are seeing now in silver, and it is the most powerful type of floor that exists. Structural support occurs when the cost basis of accumulated positions, combined with committed forward demand, creates a level below which there is simply more buying pressure than selling pressure. It is not about charts. It is not about production costs. It is about where actual capital is committed and what incentives that capital has. Let me give you a concrete example. Imagine a large institution accumulated 50 million ounces of physical silver at an average price of $68 per ounce. Their total position is worth $3.4 billion at that cost basis. Now imagine silver drops to $60. Their position is now worth $3 billion. They are down $400 million. What do? If they believe silver is going lower, they sell and crystallize the $400 million loss. But if they believe silver is going higher long term, they do the opposite. They buy more at $60 to lower their average cost. And by buying more, they create buying pressure that supports the price. Now multiply this behavior across dozens of institutions, sovereign funds, and industrial hedgers, all with cost bases in the $55 to $75 range. Every dip toward the lower end of that range triggers buying from these players. Every attempt to push price below $60 meets a wall of demand from committed capital. That is structural support. And it does not break unless those institutions fundamentally change their view or are forced to liquidate, which would only happen in a systemic crisis that would paradoxically make silver even more valuable. The Fed data I showed you earlier explains why these institutions accumulated in the first place. The money supply expansion, the debt trajectory, the declining production, all of those factors convinced large capital allocators that silver needed to be part of their holdings. And now their holdings create the floor. Now, I need to give you the honest counter-argument because intellectual integrity requires it. Here's the case against the $70 floor thesis. First, liquidity crises break all floors. In March 2020, silver dropped from $18 to below $12 in a matter of days. Every asset was sold as institutions raised cash. It did not matter that silver was fundamentally undervalued. When liquidity becomes the priority, everything gets sold. If we experience another liquidity crisis, and there are certainly systemic risks that could trigger one, silver could temporarily break below any floor. The word temporarily is important here because after the 2020 crash, silver recovered and eventually went much higher. But if you are leveraged or need liquidity at that moment, temporary does not help you. Second, the dollar could strengthen significantly. If the Federal Reserve surprises markets with more hawkish policy than expected, or if a global risk-off event drives capital into dollars, silver denominated in USD could fall, even while physical demand remains strong. Currency moves can overwhelm commodity fundamentals in the short term. Third, industrial demand is economically sensitive. I mentioned solar manufacturing as a key demand driver. But solar installations depend on subsidies, interest rates, and economic growth. A severe global recession could reduce industrial silver demand temporarily, creating a window where supply exceeds demand. Fourth, the paper market still controls short-term price discovery. Despite the COMEX inventory tightness, the futures market still sets the spot price. Coordinated short selling in the paper market can push prices below fundamental value for extended periods. We have seen this happen before. What I am telling you is not that silver cannot trade below $70 under any circumstances. I'm telling you that the structural forces supporting that level are stronger than at any point in silver market history. Breaking that floor would require either a liquidity crisis, a dollar super spike, or a coordinated paper market intervention. All of those things are possible. None of them are probable in the current environment, and all of them would be temporary. The risk-reward at current levels is asymmetric. The downside is limited and temporary. The upside is substantial and permanent. That is the framework. Let me put this in a broader historical context. Milton Friedman, who won the Nobel Prize in economics, famously said that inflation is always and everywhere a monetary phenomenon. What he meant was that sustained increases in the general price level are caused by increases in the money supply growing faster than real economic output. The Federal Reserve has increased the money supply by 40% since 2020. Real GDP growth over that period has been approximately 8% cumulative. That gap is the inflation that has already been created and that is still working its way through the system. When you measure silver, not in dollars, but in money supply units, the picture becomes clear. Silver is not expensive. The dollar is weak, and it is getting weaker structurally. James Rickards, in his book The New Case for Gold, documented how monetary systems periodically reset when debt levels become unsustainable relative to economic output. During these resets, gold and silver are repriced dramatically higher to reflect the true debasement that occurred during the expansion phase. His research suggests we are in the early stages of exactly such a reset. The accumulation by central banks, the de-dollarization by trading partners, the BRICS currency discussions, all of these are symptoms of a system preparing for transition. Ray Dalio has described this process as the long-term debt cycle reaching its end phase. In his framework, the current period is characterized by large debts, low interest rates relative to debt levels, printing of money, and internal conflict. All four conditions are present. These are not fringe theorists. These are some of the most respected economic minds of the last century, and their frameworks all point to the same conclusion. Hard assets will be repriced higher as the current monetary system strains under its internal contradictions. Silver, with its monetary history and industrial necessity, sits at the intersection of multiple repricing forces. Deep into a topic that's been buzzing lately, silver. Is it just gold's less glamorous sibling, or is it poised for a major move? Let's break it down. First, let's talk about the big picture, monetary expansion. We've all seen central banks printing money like there's no tomorrow. Historically, when currencies get devalued, investors flock to hard assets like gold and silver to protect their wealth. While gold gets most of the headlines, silver often follows its lead, but with more volatility, which can mean bigger potential upside. But here's where it gets really interesting. Unlike gold, about half of all silver demand comes from industrial use. It's in everything from solar panels and electric vehicles to your smartphone and medical devices. With the global push towards green energy and electrification, the industrial demand for silver is set to explode. We're talking about a fundamental, structural increase in consumption. Now, let's look at the supply side. For years, the silver market has been in a structural deficit, meaning we're using more silver than we're mining. This isn't a one-off event, it's a persistent trend. You don't need to be an economist to know what happens when soaring demand meets a shrinking supply. Prices have to go up. So, when you put it all together, monetary expansion driving investment demand, a green energy revolution fueling industrial demand, and a persistent supply deficit, you get a compelling case for why silver is structurally undervalued. It's not just a precious metal, it's a critical industrial commodity. The fundamentals are pointing towards a significant repricing in the future. What are your thoughts on silver? Are you adding it to your portfolio? Let me know in the comments below. Thanks for watching, and if you found this valuable, make sure to hit that like button and subscribe for more insights. See you in the next video.